Well, we had some winners and some losers today, no doubt, with this earnings season. Poor Pinterest here, taking a big hit of a 16% after hours. We had an initial dip. Initial dip was around 10%, then went down again. As you heard, some obviously some not good news during the earnings call. So down 16% now after hours. Definitely rough to see. Down to $17.50 per share on this company. So let's take a look at these earnings. Obviously, if you look first off, it is still a company that year-to-date was positive, all things considered. Now it's going to be down year-to-date. But regardless, it should be a company that really benefits, honestly, from everything going on right now. But we'll take a look at what they have going on. So Pinterest non-GAAP EPS missed by 1 cent. GAAP EPS of negative 25 cents, beats by 1 cent. Obviously, this company is not profitable, and that's something I knew going into this. As far as how this profit turned out, it's not bad, all things considered. That GAAP EPS isn't horrific, but again, it's a company that really should be trying to make profit here. They should be. I mean, they're in an industry that they have a great chance to make profit. If you look at the greats, again, I'm not saying these are going to be on Facebook level. Facebook's such a dynamic business, but if you look at who they aspire to be, a company like Facebook prints money just on the daily. A company like Google prints money on the daily. Now, obviously, you don't expect Pinterest to be at that level, but there's a good chance to really make money here. So, obviously, starting out a little bit early, it just really depends. Pinterest, obviously, if you don't know, it's a social media platform. Not one that, it was big for a couple years. A couple years ago, it's not massive right now. I wouldn't say, all things considered. I mean, people talk about Pinterest. Instagram's definitely kind of taken over that market instead of Pinterest. But let's take a look at these earnings. Still, regardless, revenue of $271 million. Plus, it's positive 34.7% year-over-year growth. That's big. Beat by 1.25 million. Definitely good there. So, revenues rose to just under $272 million. Net loss widened substantially, though, to $141.2 million from a year ago loss of $41.4 million. Okay. Oh, it's ugly. Oh, boy. Don't you hate losing $141 million when you only brought in $271? That's ugly. And now I think you might see why the shares are down. Because that is an ugly loss. My gosh. Losing that much money when you're only making, twice that amount in terms of revenue is not good. Adjusted EBITDA also fell to negative $53.3 million from $38.4 negative. Mobile active users grew 26% globally, which is a pretty crazy thing in all things considered. The U.S. was only up 6%, though. So, internationally up 34%. Interesting to see why U.S. is such a small segment of that. Yeah, it is pretty crazy. I guess the app's not as popular in the United States. I mean, for whatever reason, I didn't think it necessarily was, because it's not something you really hear much about over here that much. Average revenue per user grew 7% globally. U.S. up 18%, and internationally up 76%. Okay, not bad. United States revenue is up 27%, and international revenue up 136%, versus, again, it's not really much growth there, $35 million. Again, U.S. makes so much more of that revenue because there's a lot more cost associated with international, and you see only 13 cents in average revenue per user there. It's crazy. There's a lot of cost when it comes to digitally having a business when you're talking about overseas and stuff like that. So, not providing guidance to the pandemic, but in general says cost of revenue has generally grown with users rather than revenue, which in this environment puts some pressure on gross margins. No shocker. Expects to grow operating expenses in Q2, but at a slower pace than compared to Q1. Gosh! So they're expecting a bigger loss coming this next quarter. That's ugly. Continue to invest in the long term in the coming year, and we have a strong balance sheet to support this with $1.7 billion in cash equivalents, marketable securities, and a $500 million undrawn revolver. of debt. But we'll look at that balance sheet because I don't know what to believe about it. Let's look at this earnings presentation. Revenue overall, you do see, that's right, positive growth over here. Yeah, definitely just good positive growth. As you see, a little bit slowing in terms of revenue year-over-year growth, but again, as you grow, it's just natural that you tend to slow growth rate eventually. Monthly active users, though, has been a consistent growth since the past 5 quarters, around 25% on average for all of these. So global average revenue per user, a little bit over year-over-year. U.S. up 18% year-over-year. Globally up 7% year-over-year. Nothing massive, all things considered. Non-GAAP costs and expenses. You saw a big rise this quarter, but really it kind of matches up with what you saw last quarter as a percentage of revenue, around 36%. You hate to see that. Just that one's ugly. Adjusted EBITDA. You did see a profitable quarter in quarter 4, last quarter, obviously. But here you saw a 20% decrease from that, and we're talking about $53 million lost versus $38 million lost 1 year ago. Just ugly. What can I say? Not something you like to see out of a company, for sure. So now we're going to go ahead and real quick take a look. If it's here, I don't think it is here, but we got to look it up. We got to look at that balance sheet, baby. I thought it would be on that presentation, and of course, it just never is, right? It just never is. So let's take a look at that balance sheet real quick. We're going to scroll all the way down and say, I don't care about this report. We already saw it pretty much in that form. So as far as current assets on that company, you know what? It's fair. 740 mil in cash. Nothing, it's a good amount. 1.9 billion in terms of total current assets. Total assets in general, though, of 2.2 million. So, yeah, nothing absurd there, I guess. But, I mean, nothing absurd. A little bit less than you saw last quarter, but that's a good amount of cash for a company this size, for sure. And in total liabilities, though, it is a good number. For total liabilities, you only see 350 million versus 2.3 billion in terms of total assets. So overall, they have a lot more cash than they do liabilities. But if we talk about a company that's expecting expanded losses, I don't know if this balance sheet's going to look as pretty. Right now, obviously, the thing doesn't have a PE ratio, no doubt about it. Trading in a market cap of $12 billion, right, with an annualized revenue of less than $1 billion. Trading in a market cap of $12 billion is a little bit steep. I shouldn't say just a little bit steep. It's quite steep. And for a company that's not, it's not ridiculously massive growth either. That's one thing that needs to be considered. This growth isn't like off the chart. And it's not like I'm not saying the company's bad. I'm not saying the service they provide is bad. But just I don't know about this company. Yeah, I don't know. I'm not going to necessarily get involved with this company personally just because I don't like that loss number and they're expecting it to increase. It just doesn't seem like the kind of thing I'm interested in getting involved with right now. I have about 2 or 3 unprofitable companies in my portfolio, and I don't really like to go more than that. So if I can not do that, I will definitely not. If the stock drops maybe to $10 or something, I could consider it. But just right now, the valuation doesn't seem right for me. They're trading it at a valuation that's a little absurd for a company like this. I'm not really seizing the moment on this, so I'm not necessarily going to get involved with this one.